Hello and welcome everybody. Happy Friday. It has been a short week, but hopefully a good week for everybody. I'm here ready to talk about graphing, which is going to be the last of our Spreadsheets Made Simpler episodes. Over the past month, we've talked a lot about what a spreadsheet is, and starting off with the basics, but we've grown a lot and we've learned a lot. And today, I want to give you all a topic that I don't expect it to all be perfect today. I don't expect you all to master all of this on the first day because it's impossible. What I do want is to show you that these are there and show you how you can get started using them, because the world of graphs is huge. The options are limitless, and the possibilities of what you can get out of them is equally so. So today, I just want to open your eyes to what graphs are, how to read 3 of the most common types of graphs, and then we'll go and look at some real data to talk about how these graphs can be used with real stock data. Now, if you've really enjoyed this series, and saying that this is the last Spreadsheets Made Simpler series is sad, don't worry, because this is only the beginning. Learning how to use spreadsheets and learning how to do the data analysis yourself, create your own conclusions, and create your own information is empowering. It is the reason we created Sectors Made Simple. We created Sectors Made Simple not because we wanted to sell it. No, we created it because we wanted to use it ourselves. We looked at the market, we looked at what is available to everyone and said, that's not enough. So we went out and we created the matrix. We went out and started doing these webinars, because that is where the value is. It's not learning a strategy so that you can follow that strategy and hope that it always works. It's teaching you the skills. It's building the knowledge so that you get to take control of your own financial journey, as well as figure out how far you want to take it. So for everyone that this is where they want to end their exploration into spreadsheets, thank you for joining us. It has been a pleasure to get to open your eyes to a new area, a new field that you can get involved with. But if spreadsheets have been something that you've enjoyed and you want to learn how to do more, including going to Finance Yahoo and grabbing the data automatically, or creating an entire watch list that you give it a ticker and the rest is like magic, it does it all for you, then I'm happy to say that this is not the end. After this class ends, next Friday, I will be doing a little bit of an introduction to what the advanced class series will be. It's going to be all about Google Sheets, all about Excel, but we're going to take things a step further. I'm going to teach you almost everything that I know in Excel and Google Sheets and show you how it can be used. Not just to say, here's a bunch of cool information. No, we are going to build dashboards, build watch lists, build usable tools. So by the end of the class, not only do you come out with more knowledge, but you come out with more tools available to you to invest smarter, faster, and simpler. So that's a long way of saying today is the end of chapter 1. I hope you all are ready to read chapter 2. So let's get right into the conclusion of this class series with graphing. But before we do that, I want to say hello to everyone we have with us live here. Hello to Blaze, Melly, Laura, Chela, Josefina, Eddie, Andrew, my mom, JP, Nidia, Magnolia, Yenica, Martha, Erika, Elizabeth, Horte, Mayra, Nancy, Rina, Narda, Brenda, Paola, and more. Thank you all so much for joining us. Let's get right to today's topic, which is going to be all about graphing. So, because I want to give you all usable information, I'm going to be covering some stuff today that talks about trading strategies. So, because I'm going to be talking about how spreadsheets can be used with strategies, I need to mention this. I'm talking about strategies that, yes, they are real strategies, and they're using back-tested returns, which means that we have a way of testing matrix strategies, that you give it a strategy and it tells you how that strategy would have done in the past. That is real, that is fact. Those are real returns that you would have seen. But just because we made money in the past does not mean we'll make money in the future. Your flip phone from 2000 may have been a great phone back then, but isn't so much now. Times change and our strategies need to change with it. So please take the example that I share today as an educational example and always do your own research before making any investment decisions. Now, let's cover some of the stuff that we talked about in last week's webinar. So in last week's webinar, we learned that we can import data into Excel and Google Sheets. And we can do this very, very easily by downloading files that are called CSVs, comma separated values, or XLSX. That one doesn't stand for anything. It just is. What they do mean is they are what are called file extensions. And they are the file extensions for two of the most common data types that we can get. File types or file extensions are just a way for the computer to know, what is it? Do I open it with photos? Do I open it with Microsoft Word? Do I open it with Excel? It just tells it how to open it and how to read it. But CSVs are the most simple and the most common type of data. They are very, very basic. They can be read in a note. They don't need any special programs. You can open one in whatever program and be able to read the information. But to get the most out of it, yeah, we want to put it into Google Sheets or put it into Excel. And we can get CSVs for stock data from, well, a number of places. But the one I always go to is Finance Yahoo. Underneath there is the historical data section. So if we go here and we want to look up SPY, we can click right over here on historical data. And then we can choose how long we want the data. And if we click download, ta-da! We now have that data that we can open. And it's not easy to read, but it's readable. So we can see that we have date, open, high, low, close, adjusted close, and volume. Then we have all of the information in it. And what will happen is if we take that file and open it in Excel, something magical happens. Let me just go over here. So let me open this in Excel and we'll take a look at what it would look like. There we go. This is what that same file looks like when we put it into Excel. We can work with this. This is good information. So that is what CSVs let us do. It lets us go somewhere, grab a bunch of stuff, bring it home, and then unpack it so we can have a nice dinner at home. So we're not going to save that. We're going to ignore what that says. We'll come back to that later. But let's talk about what we will learn in today's webinar. Today we're going to learn what graphs are. Pretty simple. We're going to talk about three of the most common types of graphs that you'll see, not in general, but in the financial world. Again, I want to bring all of this back to investing and making sure that it makes sense for investing. Then we'll talk about how to prepare data. So we do need to do a little bit of work before we just tell it, hey, turn this into a picture. So we'll talk about what that work is, as well as we'll go through and do an example of it. And then we're going to talk about how to make some basic graphs in Google Sheets, and of course, do some examples. So first things first, let's talk about what graphs actually are. Graphs are a way of looking at information in a very, very visual way. It turns numbers and tables into pictures. Now, these pictures will usually have a couple of things in common. It's going to have a line this way, a line this way, and probably a title. But we can label the line this way and the line that way by calling them axes or an axis. So graphs have two sides. They're two axes, horizontal and vertical. Horizontal, left to right, vertical, up to down. The horizontal is called the x-axis. So that is our left to our right. That is our x-axis. Then the vertical is called the y-axis. Why? I don't know. They just decided. But x, left to right, vertical, y-axis, bottom to top, top to bottom, tomato, tomato. And to know what actually goes where, we need to first talk about something called dependent and independent values. I don't expect all of this to be obvious, but the best part is you don't really need to worry about it. Dependent and independent values, they just work. They just do what they need to, and in most cases, what we're using is already made dependent and independent. And it's a lot simpler when we break it down. So let's break it down. Independent values are numbers or values that do not change because of other numbers. They don't care what Juan is doing. They're going to still just do their own thing. And because of this, they are usually consistent or constant numbers, such as time, age, even something like height can be an independent value. It's not your height is based on what you had for dinner yesterday or how much you had for dinner yesterday. But what is how much you ate for dinner last night may be based on your height. If you're taller, you may need to eat more food. If you're shorter, you may need to eat less. So how this actually looks on a graph is that our independent values are usually on the y-axis. Then our dependent values are going to be numbers that rely on another number. So here, these are typically numbers that are going to be relying on the independent. And these are typically on, oh, these are backwards. It should be the x-axis is the independent, the y-axis is the dependent. But really, x-axis, y-axis, most of us don't need to worry about that. What we do need to worry about is we know how they work together. So let's go and do an example. So we give 100 students a math test. And these students, we're going to be very unfair. We're going to give the same test to kids of all ages, from 5 to 15. And what we can do is we can say, based on how old you are, what was your score? So age, I don't know why I keep saying y-axis. It should be the x-axis is It's not dependent. Your grade doesn't tell you how old you are. How old you are may tell you what your grade is going to be. So then the grade is on the y-axis, or the vertical. So left to right is going to be our age. Grade is going to be up and down. And a great example of this is a stock chart. So let's go and look at that together. So let's go and let's get, I just want a very, very simple chart. So for that, I'm going to go to Finance Yahoo, and let's open up SPY. So let's get rid of all this extra stuff. So we just have our line. So what we're looking at here is technically a graph. Charts are a type of graph. And what we have is the price is the up and down. That is our y-axis. Our x is going to be our left and our right, our time. The stock price doesn't tell us what time it is. The time tells us what the stock price is. So in this case, time is our independent. Time doesn't care what the price of the stock is. The price is based on the time, because something that happened a week ago is different than what's happening today. So that is the way that this works. We have time from left to right, and then the price goes up and down. So we graph price over time. And that's about as simple as it is. So in this case, we have our dependent, or sorry, let's start with our independent. Our independent, which is our time, and our dependent, which is our price. So the great thing about this is that more than one dependent value can be graphed if they have the same independent variable. So what that means is that each of these dependents will have a different color so that we can tell the difference. And we'll also have a key. It's called a key or a legend. It's some way of telling us what each line actually means. And a perfect example of this is a perf chart in stock charts. If we open up stock charts and we go down here to perf charts, we'll just do our sector ETFs. This right here, I'll do this one. This right here is a line chart. It's a type of graph. And what it's looking at is time is our left to right. Price is our up and down. And we see there are a ton of lines. It's not just one line. We have 1, 2, 3, 4. It should be 12. I'm not going to count. 12. So what that does is it lets us put all of these things into one chart. The time is the same. The prices are different. And that thing I was telling you about, the key or the legend, this chart has one. And it's right over here. That is our key. It is our way of knowing that the dark blue line is right there, is discretionary. Just like we know the normal color blue line is financials, and so on and so forth. All of this, we can use the color to know which line it is. So if I were to look and see the lime green, this green right here, I know because I can look up here that it's the communications sector. So all of this is letting us look at one chart and get much more information than just a single line, as long as the times are the same. We can't do any of this if the times are different. So that is important. We need our time to be the same so that we can graph everything together. Now, what if we wanted to look at just 30-day returns instead of it being from, I don't know, August 19th to June 4th? What if we wanted it to just be 30-day performance? There, what we would need to do is, instead of saying August 19th, August 20th, August whatever, day 1, day 2, day 3, day 4, day 5. So we can change what our x-axis is if we want to work with different types of information. Again, do you need to worry about that right now? No. But I will still go through an example with you all so that we know that you can do it. It's not hard, you can do it. So, let's now go and look at different types of graphs so that we know what they are. Because not all graphs look the same. Some are prettier, some are a little different, and some work better for different types of information. So, there are a lot of different types, and again, not all graphs are the same. Different graphs will be better for different types of information, but again, we're going to go over the most common types so that we know what they are. The first one, and all of you should already be familiar with this one, is our line chart. A line chart puts little dots on a graph, where each dot is a piece of information. Let's say, what was the closing price of the stock today? What was the closing price yesterday? So what it would do is it would say, June 4th, the price goes right there. June 3rd, the price goes right there. So on and so forth. And then, much like my favorite game when I was a kid, we play connect the dots. We draw a line from one point to another. So that's it. We just get to see the price changes over time. And we see it in the form of lines going up and down. The best example I have for a line chart is, it's just a stock chart. Stock charts are line charts. This is a line chart. There's not much more to say about it. If you look here, you can hover over, and each point is, well, if I zoom in, is 1 day in the market. In this case, it doesn't seem to be 1 day. There we go. Now each one is 1 day. So as we go along, wait, it's 1 minute. No, I want 1 day. There we go. So now we can see, if you look down at the bottom, right down here, you'll see, oh my goodness. Sorry, technical difficulties. There we go. You'll see how the date will change 1 day at a time. That's because what it's doing is every day it says, what is the price? What is the price? What is the price? What is the price? And what we're graphing is that price over time. So every day is 1 point, and then between each of those points, we draw a straight line. So you see, for example, here, that's 1, that's 2, that's 3. we see how it jumps from point to point. The sharper lines means it jumps a lot faster. Slower lines means it went slower. So that is line charts. You should already kind of know what they look like, because it's anytime you look at a stock chart, unless it's point and figure, it's going to be likely a line chart or even candlestick. Candlestick is similar, but not the same. We're mostly talking about line charts. But now let's go on to one of my favorites, because it reminds me of pie. Pie charts. Pie charts take information and they turn it into a circle, or think about it like a piece of pie, where the size of each slice depends on how big or small that one number is compared to the others. And these pie charts are typically out of a percent. They will be 100%. But anything, as long as its parts add up to a whole, can be used as a pie chart. So for example, you could take your birthdays, everyone's birthday, and we create a pie chart. So we can say that 18% of us have birthdays in November, 12% have birthdays in December, only 5% have birthdays in February. So it lets us take a group and break it out into smaller slices. But a great investing example of a pie chart is holdings, more specifically an ETF's holdings. So here's a perfect example. We can look at technology, XLK, and we can look at what they own and see what percent of their portfolio is these different things. So in this case, it all has to add up to 100%. That's how we get our full pie. But here we can see the biggest slice of that pie, 48.68%, for technology, our software and IT services companies. 23.3%, this one over here, are computers and phones. 19.6% are semiconductors. And then it gets smaller and smaller and smaller and smaller and smaller from there. You can do the exact same thing with companies, where if I open up XLK on ETF.com and we scroll down to holdings, ta-da! So now what we have here is we have their top 10 sectors, their top 10 companies. We can see that XLK is holding 21% of their portfolio is in Apple, 20% of their portfolio is in Microsoft, 4.5% in Nvidia, 4% in Visa, smaller and smaller and smaller. But what's this giant gray section? Well, remember how I said that our pie charts need to add up to 100%? This is how they do that. Because all this is looking at is the top 10 companies. Number 11, they probably are holding 2 point something percent. We don't get to see that though. What we know is that the top 10 is 66%. So there's 34% that is just smaller stuff. So this big gray section here is that other 34%. Pie charts need to add up to 100. That way, we can say how big is everyone's piece of the pie. In this case, how big is Apple's piece of XLK? 21%. How big is Intel? 2.46%. So pie charts give us a very visual way of seeing how much bigger or smaller things are. It's all relative. Everything comes back to relativity somehow. The last one that I want to share with you all are bar charts. So, bar charts are used for information that's what's called categorical, or information or data that isn't in a row. So for example, you may say instead of age, where every single point is a different day of the year, you may say January, February, March, April. So this would be turning a numerical thing, or what's called continuous, into categorical. Or another way you could say it is age. Instead of saying 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, you may say 5 to 8, 9 to 12, 13 to 15, creating little groups or categories. And with this, what we'll have is a categorical X. So instead of our left to right being our continuous, our date, it's categorical, where each category becomes a line. And how big, a box or a rectangle. How big that rectangle is depends on what we're looking at. So the left and right, it's just spaces. And in each space, we have stuff. The stuff is a number. How big that number is determines how big or small our rectangle is. And you can still add multiple lines per category. And I'll go through an example of this later. But bar charts are best seen through examples. They're very hard to think about until you see them, and then you're like, duh. So let's look at a bar chart. Seasonality is something that I've talked quite a bit about in previous webinars, but it's a bar chart. This is an example of a bar chart where the x-axis is the specific month. It is January, it is February, it is March, it is April, it is May. And then the y-axis is the percent of years where the security closed higher than it opened. We can see that the rectangle for 100 is bigger than the rectangle for 80, which is bigger than the rectangle for 75, which is bigger than 60, which is bigger than 50. The higher the number, the bigger the rectangle. These charts are extremely cool because what it lets us do is it lets us now look at information, but in a very visual way. We're not saying January 14th. We're just saying January. Just like we could say height. We could say 5 foot to 5'4", 5'5" to 5'10", so on. But we can also add, like I said before, multiple columns per category. So take the test score example we had earlier. And now what we can do is we can make it into a bar chart where instead of saying 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, we turn them into groups. 5 to 8, 9 to 12, 13 to 15. And we can add a second column if we wanted by saying, are they male or female? So we break out the scores to say 5 to 8 males got this score. 5 to 8 females got this score. This is very, very, very common. And what it ends up looking like is something like you see on the right, where every single category is on the bottom, but each category has more than one line. This doesn't mean that the orange comes after the blue. They're both in the same category. So now that we know what some of these common charts look like, some of these common graphs, let's go and let's look at how we would prepare our data. Again, we need to do a little bit of work so that these graphs give us something useful. So to make graphing easier, what I recommend doing is taking your CSV or taking whatever data and copying and pasting it into a new sheet. It's just an easier way to organize it, especially when you start working with multiple sheets, multiple stocks, multiple columns. It gets messy quick. So I always like to take my entire information that I want to turn into a graph and just put it all together. I also recommend having no blank. So don't have information blank information. It's going to confuse Excel. It's going to confuse Google Sheets. So we want to make sure that everything is nice and cozy. There's no blank space. And the last thing is use a new sheet. So don't try and make this on something that you have a bunch of other information. Give it its own section. And data for charting should have this. And this is the most important part, because this is how the charts create themselves. Again, can we create charts manually? Yes. Do we want to? No. We want the computer to do the work for us. So to make the computer do the work, we need to give it column headers. So each column doesn't start with the first piece of information. It says date, stock, open, high, low, close. That first row tells the computer what does each column mean. Then on the left side, we have our row headers. Same thing. They are usually what's called an index, or it's the number that we want to use as our x-axis. In this case, it's going to usually be date. So our row headers would be March 1st, March 2nd, March 3rd, March 4th, March 5th, March 5th, or 6th, whatever. And then these row headers, again, will become our x-axis. So it is very important that these are labeled. And the last important part is data. What good is a chart if you don't give it data? So I'm going to stop talking. Slides, I feel like, don't do all of this justice. Let's just go and do some charts. So we're going to start off with a very, very simple example. I'm going to go here, and we're going to take the returns that I had just downloaded, and we're going to boot those up into Google Sheets. So to do that, we need to go to Google Sheets, into a blank, and we're going to import our data. So we go to File, Import, Upload, and then we're going to drag in our data. All of this looks good, so we click Import Data. Ta-da! So now, let's get ready to graph something. What I want to graph is the adjusted close price. So I'm going to go down here to the bottom left, right down here. I'm going to hit the plus. So now we're in a new sheet. And to choose between what sheet we're looking at, we need to either click here or here. So when we go back to here, we have all of our data. And remember, we need a couple of things. Column headers and row headers. So first thing we're going to do is we're going to get our row headers, our independent values. So to do that, we click on the A, so we highlight the entire column, copy, and paste. So now what we have is we have all of our dates in the new spreadsheet. Then let's grab our adjusted close. So we can do this, copy. We're going to click on the B or click on the first cell and then click paste. Lucia is asking, Sheets is the version of Excel or vice versa? Excel has been around for over 20 years, so Excel is the standard. Google Sheets is a free alternative that is more recent, but in my opinion, is a lot smarter. I find, and you'll see for graphing especially, that Google Sheets makes it easy. Super, super, super easy to graph, to import data. It's just smart. So for most things, Google Sheets is the best. The advantage to Excel is Excel lets you write code. You can actually write programs to run with your data. So it's really good for larger companies. It's really good for, really for larger companies and for institutions that want those extra tools. Google Sheets is really basic, but basic's not bad. Again, I find Google Sheets to be easier in every way, except for if you want to write custom scripts, which I've done once in my career. Besides that, Google Sheets has a lot of stuff that Excel can't. Like, I can go and let me see if I can grab this for you all. Don't worry if this is something kind of crazy. I will break this down in a future webinar. But what I can do is I can go in and I can ask, hey, Google Finance, get me the beta of Apple. And it will go search the internet and bring me back the beta for Apple. I can also do it with price. Well, if I formatted it correctly. There's the mistake. It will go and grab me the price. You cannot do this in Excel without an extra program to grab you that data. So Google Sheets, because it's connected to the internet, super quick, super fast, and can bring in data from another website. Excel is much more advanced and is better for a place that already has their own information and so on and so forth. But let's get back to the graphing. Again, if you're interested to learn more about the differences and actually run into the situations where you're now doing things that only Google Sheets can do, join us for the members or for the advanced Excel classes. I'll be showing you how to build a watch list that imports all of the data because Google Sheets is cool like that. So we now have our date and our adjusted close. So what I'm going to do is I'm going to highlight. So all I'm doing, I'm clicking on the A and then I'm dragging to the right to highlight everything. So when you click on A or B or C, it highlights the entire column. When you click on 1, 2, or 3, it highlights the entire row. So I'm going to click and hold A and then drag to B. So now if we see, I have all of this highlighted. Then to actually add the graph, we go to Insert, and then click on Chart. If you notice, there is no option for bar chart, line chart, any of that. It's just chart. But it figures it out. It knows that we probably want a line chart. But if we don't, you can choose to use bar charts. Pie chart's not going to work, but you can do a line chart. It just looks a little goofy. Or sorry, a bar chart. Line chart is the obvious choice for this type of data. So this is how you end up getting a chart. And we can make it bigger, we can make it smaller. We can also download it if we want to download it as a picture. So now we have that as a picture. Or you can also move it into its own sheet so that you can look at it much, much bigger. So that is how you make a line chart in Google Sheets. It's really that easy. You don't tell it what you want, it just does it for you. It knows that because you're giving it date and adjusted close, that you probably want a line chart. And that's what it makes for you. So again, to do that, we want to take the columns that we want, and we always need our column headers. In this case, it's date and adjusted close. And we want our row headers, our dates. And we can also add more columns if we want to. So let's go here and let's add close price. And we'll go ahead and we'll delete this. And now we're going to graph adjusted close and close over time. So again, click on A, drag over, insert, chart. It looks pretty normal, right? Until we move it into its own chart, at which point we can see that it ends up being the same thing. But as you go back in time, the lines start to go further and further apart. Very cool way to see the difference between adjusted close and close. Here is the first point where they start being different. Here they get even more different. And then here they get even more different. Dividend dates. So that is a very simple line chart in Google Sheets. Let's now go look at how we would do the same thing in Excel. So what we're going to do is we're going to go here to New Blank Workbook, and we're going to go through the same steps we did last time, where we go to import our CSV. So to do that, I'm just going to cheat. I'm just going to go to here, File, Open. And now same thing. We click on the plus in the bottom right, and we do copy and paste. Actually, let me copy as opposed to cut. Copy, paste, copy, paste. So this is the same thing we had in Google Sheets. So we're going to do the same thing. Click on A and drag over. And here we go to Insert. And then we can click on Recommended Charts. So it will help us and give us a little bit like Google Sheets does. Or we can tell it the specific type of chart. And the thing that I really like about Excel is you have options. So you can have your very, very basic chart. And just like with the other, you can move it into a new sheet by right-clicking, move chart, new sheet, and then it makes it bigger. But again, we can change the layout of it. We can change a lot of things. We can make it look pretty. Excel gives you a lot of options for making data look prettier. Or say you want it to be, let's go here, and, oh, not column. Say you want it to be a 3D. You can, I don't know why you'd ever want it, but you can make it 3D. You have the choice. So Excel gives you more customization, but you need to do a little bit more work. Google Sheets, a lot less work, a lot easier, and still useful information. So let's now go, and I want to show you two more cool things in Google Sheets specifically. The first is now I want to go and for Sectors Made Simple members that watched Tuesday's webinar, you should already know what this is, but for everyone else, we have on the matrix what's called a backtesting engine. What it lets us do is we can test out a strategy. Let's just say X count of 6 or more. And then use that strategy to see how it would have done over time. And compare it to the SPY. Compare it to the S&P 500. Oh, hey, look, we beat the S&P 500 by about $500. We like that. But you can also download your backtest. So I did this with all of the members live, where we went and we tested the same strategy, but changed. Does it start on Mondays, Tuesdays, Wednesdays, Thursdays, or Fridays? And let me tell you how simple this strategy is. Once a week, you open up your computer, you go to the matrix, you look at one number, and you buy or don't buy whatever it says. That's it. See you next week. These trades can be done in 5 minutes. From you open your computer to you close it, you've already bought your new ETF. It's really that simple. And they outperform the market consistently. How much? Well, I've summarized it in this total return difference column. Monday beat the market by 1.8%, Tuesday beat it by 5%, Wednesday beat it by 6, 9. If you trade on Fridays with this strategy, between January 1st and June 1st, you would have made 25% more than the market. We're not talking 25% profit. We're talking 25% more than the SPY. It's pretty good if you ask me. But let me show you what we can do now that we know about charting, right? So I'm going to go here and I'm going to make a sheet for, oh, this is Excel. I want this in Google Sheets. Let me see. Where is the Google Sheet one? Here we go. Here's the Google Sheet example. And we'll do it here together. View, zoom, make it big. All right, cool. So in the bottom right, I'm going to add a new sheet, and we're going to name it data. And we see here we have Monday, Tuesday, Wednesday, so on, right? But we need to do a little bit of tweaking here, right? So what we need to do is, because these dates are different, we need to have it be week 1, week 2, week 3. So what I'm going to do is I'm just going to grab sell date, paste that in, and then our strategy capital. Actually, I'm going to move that here, and I'm going to add SPY so that we're comparing against the market. But instead of having dates, I'm just going to make this be week 1, week 2. And remember, as we learned in lesson 3 with copying formulas, I can drag down and it will copy the formula for me. It doesn't even need to be a formula. I just told it week 1 and week 2, and it figured out the rest. So I'm now going to go and grab the strategy return from Tuesday. So Monday returns, Tuesday returns, Wednesday, Thursday, and then Friday. That got a little wonky. So we see here that we have 2 extra pieces of information here. Part of cleaning it up is we don't want blank. Here we have blank. So the way we fix that is we just remove we trim off the edges a little bit. And now we just click, drag, insert, chart. Done. And now what we have is, let's put this in a new chart, or move it into its own sheet. So now what we have is strategy returns, where we can see SPY is down here at the very, very bottom. And over time, we can see that our returns change from week 1, 2, 3, 4, 5, and so on. And we can even edit it where if we don't want it to be from 0 to 15,000, you can change what days that chart is. So you'd go here to chart and axis titles, and from here you can change how often, or actually it would be under vertical axis. You can choose the minimum value, so in this case we want 10,000, and the maximum value 15,000. So boom, now the graph is even bigger, so we can see things with more detail. And again, let's look at what this has done for us. What we have done is we started with sectors made simple backtesting data. We imported it so that we could then compare. If we did the same strategy, what day of the week should we trade it? Monday, Tuesday, Wednesday, Thursday, or Friday? And then we look at it here, and it seems pretty obvious that trading on Fridays using this strategy seems to be the way to go. And this lets us visually see over time why. We have our summary, yes, and you want to know what? We can also turn this into a bar chart. So now we have a bar chart to see the average returns, the total return difference, the best returns, and the worst. What was the average? How much better did it do than the SPY? What was the best period it had? And what was the worst period it had? The best week and the worst week. It turns the information into something visual. It lets us take a lot of stuff and turn it into something very, very usable and very intuitive. Again, I've tried to show you the very tip of what you can do with graphing, but it's deep. It goes very, very deep. So with this, now you know it's there. Now you know 3 of the main charting types, and now you know how you can use those charting methods with data that you already have, be it normal stock data, or if you're a Sectors Made Simple subscriber, a strategy that you've tested. And I'll tell you what, the strategies, at least backtesting wise, work. We found this strategy. This is not some new strategy that we just found because it was the best strategy. I gave a webinar on this strategy 2 months ago. 3 months ago at this point. So you would have been about right here. So from here to there is where we could have gotten had we been using this strategy. 5 minutes once a week. So that is spreadsheets made simpler. They are not something that in 5 webinars, in 5 hours, I can teach you everything there is. This is something that takes years of practice, not to learn how to use, no, just to make the most out of it, but more importantly, to figure out how you want to use it. Spreadsheets are a tool for you to use. And I hope in these 5 webinars, I've shown you how I use them and how you can get started using them yourself. But if you want to learn more, if you're curious about what spreadsheets can do from here, please join us next Friday, where I will go into much more detail about what these advanced series will cover, an example of what I can build using Excel, and show you how by the end of that webinar series, you will be able to build it as well. I want to share one more thing with you all because we had an awesome update to the matrix today, where on the matrix, if you now go and scroll down to momentum, you can choose compared to, and usually you could set your 1 week ago, 2 weeks ago matrix here. If you scroll down, there is now a new option called custom. And what this lets you do is compare today's matrix against any matrix in the past. Let's do July 1st of 2020. And what this will do is it gives us a momentum table compared to July 1st of last year. And if we scroll down, you can see the matrix from that day. This is not only 3 weeks ago. This is not only 1 day ago. You choose what momentum you want to use to make investing simpler for you. So thank you again for joining us for this Spreadsheets Made Simpler series. I really hope you all have taken something away from it and learned why spreadsheets make investing, finding strategies, testing those strategies, and seeing the results that much simpler. Thank you all so much. I hope to see all of the members for our members webinar on Tuesday. And for everyone else, I hope you all join us for the introduction of the advanced Excel series that I will be giving next Friday, same time and same place. Thank you all so much. Have a great weekend, and we'll see you all very, very soon. Bye.